So Warren Buffett he just piled up $325 billion in pure cash, which is, I mean, just to put that number into perspective, he could buy Disney, Spotify, and Ford tomorrow, in pure cash, and he'd still have enough left over to just casually buy Delta Airlines.
Yeah, it's an absolutely staggering amount of liquidity.
Right. And when the greatest investor in history builds the financial storm cellar that massive, it means he sees a tornado coming on the radar. So today, we're looking at that radar.
We really are, because when you look at the underlying data of what the smartest money in the world is doing right now, you quickly realize we aren't looking at one cohesive market.
No.
We are looking at a really incredibly complex, just fragmented landscape.
Yeah, and that is why we are doing this deep dive into the week of August 11th through the 17th, 2026. We're unpacking a really massive stack of research today. It's a comprehensive weekly market briefing that aggregates daily market action alongside Danielson AI algorithmic scores and Dataroma as tracking of 13F filings.
Right. And just to set the table for the listeners, 13Fs are essentially receipts.
Yeah, the receipts.
Yeah, they're the receipts that institutional investment managers who have over, $100 million, they have to show these to the government every single quarter.
Exactly. So it is our window into where these, super investors are actually placing their bets right now.
And what's fascinating here is the core theme emerging from all this data. The sources are calling it the market divide.
The market divide.
Yeah. We are witnessing this violent tug of war. So on one side, there is this selective, hyper-concentrated dominance in AI semiconductors.
Right.
But then pulling hard in the exact opposite direction is this massive rotation into traditional value stocks and very heavy defensive hedges.
Okay, let's unpack this, because on the surface, things look perfectly calm. The Dow is hovering near 54,000, the S&P is sort of just treading water, and the NASDAQ seems fine. But under the hood, billions of dollars are violently shifting around.
Oh, absolutely.
So to understand where all this money is flowing, I think we first have to look at the geopolitical anxiety that really kicked this whole rotation into high gear at the start of the week.
Yeah, so the catalyst really starts with the macro backdrop on August 11th and 12th. The broader market essentially just stalled out.
Yeah.
And this was driven by escalating geopolitical tension in the Middle East, specifically surrounding the Strait of Hormuz.
Which is huge, because the immediate impact there is always oil, right?
Yeah.
We saw Brent crude oil get pushed up, and it's sustained in that $85 to $95 range.
Exactly.
And when energy prices get sticky at those levels, that's when the billionaires start making structural moves. Which brings us, I guess, back to Warren Buffett's storm cellar.
Right, the $325 billion.
Yeah, the $325 billion. So I have to ask, is he just being a grumpy, old-school value investor who refuses to buy high-flying tech? Or does $1/3 trillion in cash signal, like a genuine systemic danger?
Well, to answer that, we have to look at the mechanics of what our sources call his valuation discipline plus energy hedge. Because Buffett isn't just, hoarding cash under a mattress. He's not just sitting on it.
Right, he's moving things around.
He is making very calculated adjustments. So he systematically reduced his position in Apple by 10%.
Wow, 10% of Apple.
Yeah, he's taking profits where valuations are just historically stretched. But I think more importantly, look at what he's buying with some of that cash.
He is building up traditional energy positions.
Precisely. He added 5% to Occidental Petroleum, which is OXY, and he added 3% to Chevron.
Okay, so he's using that $325 billion cash pile as basically a valuation buffer.
Yeah.
While simultaneously using traditional oil and gas as a geopolitical floor for his portfolio.
That's a great way to put it. He knows that if the Strait of Hormuz is actually compromised, energy stocks are going to inversely spike against a broader market sell-off.
Right, because if oil can't get through, the supply drops, price goes up, and his oil stocks go up while everything else crashes.
Exactly. And he is not the only one batting down the hatches either. If you look at Ray Dalio, the founder of Bridgewater, he made some staggering defensive moves this week too.
Yeah, he initiated a brand new position in ConocoPhillips.
He did. But he went much further than just oil. Dalio massively increased his exposure to long-term treasury bonds. He brought his TLT position up by 18%.
18% is a huge jump.
It's massive. And then there's the biggest anomaly in the data, in my opinion. Dalio made his largest single move of the week in gold miners.
Wait, really? Gold's miners?
Yeah, he pushed his GDX position up by 22%.
Okay, so Dalio is clearly playing defense, but gold miners. not just physical gold, because that feels like a very specific, almost aggressive way to play defense, Like, why take on the operational risk of a mining company if you're really just looking for safety?
Right, and that distinction is crucial. If we connect this to the bigger picture, Dalio is hedging against deep fiscal and monetary uncertainty because the data explicitly outlines a 30% probability risk of Middle East escalation.
Which is high.
It is, and that would send oil well past $100 and likely trigger stagflation.
Stagflation, so that's stagnant growth combined with high inflation. Right.
Exactly. And stagflation is...
Which is basically kryptonite for a standard stock portfolio.
It really is. It destroys standard portfolios. Now, regarding gold, physical gold or an ETF like GLD, that is a pure safe haven. It just tracks the price of the metal.
Right. It just sits there.
Right. But gold miners, represented by the GDX ticker, they offer operational leverage.
What does that mean exactly, operational leverage?
So if the price of gold goes up 10%, a mining company's profit margins might actually double, which sends their stock up maybe 30%.
Oh, wow.
Furthermore, miners pay dividends. Physical gold just sits in a vault. It doesn't pay you anything.
Okay, I see. So Dalio is buying portfolio insurance, but he's buying insurance that actually pays him a yield and offers a multiplied return if his worst-case stagflation scenario actually plays out.
Exactly. You want the defense, but you still want the leverage if things go sideways.
That makes total sense. And he is funding this by reducing his broad market exposure. The data says he cut his SPY position, which tracks the S&P 500 by 12%, and his QQQ NASDAQ tracker by 15%.
Yeah, he's definitely pulling back.
So Buffett and Dalio are out there hoarding cash, buying energy, loading up on long-term bonds and gold miners. I mean, they are bracing for impact. But while they are building these bunkers, another group of super investors is effectively buying the casino.
Yeah, this is where we enter the AI exemption side of the market divide.
Oh, this is fascinating.
Mm-hmm.
Let's look at the core contradiction of the week.
Right.
So broad technology as a sector was down 1.3% for the week. Communication services was down 1.5%.
Right.
So on a surface level, tech had a bad week. Yet AI semiconductors are absolutely surging.
Yeah, the divergence is stark here. The underlying data makes it really clear that this is not a tech bear market. It is a concentration rotation.
Concentration rotation.
Yeah, so the capital isn't leaving tech entirely. It's just funneling into a very specific bottleneck.
I like to think of AI hyperscaler spending like the transcontinental railroad.
Oh, yeah, that's a good way to look at it.
Like Meta, Amazon, and Google. They aren't really betting on the passenger trains yet. They are just buying up all the steel and laying down the tracks as fast as they physically can.
Yes.
And that's why NVIDIA, which is basically the company making the steel in this analogy, is completely decoupled from the rest of the tech market.
Exactly. And look at David Tepper's moves this week. He added 15% to his NVIDIA position, 12% to Meta, and 8% to Broadcom.
Wow.
But at the very same time, he actively reduced his holdings in Amazon by 8% and Google by 5%.
So he is identifying the absolute core of the infrastructure and just hammering it.
He is. And this isn't just a discretionary gut feeling on Tepper's part either. The Danilfin AI scores provide some really fascinating algorithmic validation for this.
Yeah, I want to talk about those Danilfin scores because for anyone listening who isn't familiar, they essentially use artificial intelligence to analyze technical, fundamental, and sentiment data to rank stocks from 1 to 10 on their probability of beating the broader market over the next 3 months, right?
Yep, that's exactly what they do. And NVIDIA, Broadcom, and TSMC, which is Taiwan Semiconductor, they don't just have strong scores. They registered perfect 10 out of 10 Danilfin scores this week.
A perfect 10. That's rare.
Very rare. And Meta and Google are sitting right behind them at a 9 out of 10. Our sources identify this dynamic as the new moat.
Okay, the new moat. Because the traditional economic moat is usually something like, a powerful brand name or regulatory advantage that just keeps competitors away. But this moat is built purely on capital expenditure or CapEx.
Exactly. The hyperscaler CapEx is the moat. The forward guidance from Microsoft, Google, and Amazon for their capital expenditures on AI infrastructure, it remains completely intact for 2025 and 2026.
Meaning they aren't slowing down their spending anytime soon.
Not at all. We're talking about hundreds of billions of dollars contractually locked in to buy these specific chips, servers, and cooling systems.
Oh, wow.
And that wall of money, it provides a structural floor under the semiconductor stocks. It basically isolates them from whatever macroeconomic headwinds are dragging down the rest of the tech sector.
So it doesn't matter if the broader economy slows down because these massive tech giants have already promised to spend the money.
Exactly. The checks are already written, basically.
That's wild. And we see Ken Griffin of Citadel playing a very similar game. He is actively long on tech names like Meta, NVIDIA, and Tesla, but he's simultaneously shorting the VIX.
Yes.
And shorting the VIX means he is betting heavily against market volatility spiking, at least while the index is under 15. That is immense confidence in the resilience of these mega-cap AI names to hold the broader market up.
It really is.
But let's pause here, because the source material isn't universally euphoric about AI. It explicitly mentions a 20% risk of AI capex digestion.
Ah, yes. The digestion risk.
Yeah, so what happens when the tracks are laid? Like, at what point does Tepper's high-conviction infrastructure play become just dangerous overexposure?
Well, that 20% digestion risk is the single most important metric for the AI bulls right now. CapEx digestion essentially means the hyperscalers pause their spending. They stop buying the steel, to use your analogy, just to see if their software revenues actually justify this astronomical hardware spend.
Right, because eventually you have to sell tickets for the passenger train.
Exactly. And if they pause, the semiconductor revenue projections collapse. But, the super investors aren't flying blind here. The data provides the exact hedging strategy being used to manage this specific risk, which is put spreads.
Okay, put spreads. Let's break this down for the listeners. How exactly does a put spread protect a massive position in something as volatile as NVIDIA?
Sure. So buying a standard put option gives you the right to sell your stock at a specific price, right? It acts like traditional insurance.
Right. So if the stock crashes, you're safe.
Exactly. But because AI stocks are so volatile, buying that insurance outright is incredibly expensive. The premiums will just eat your portfolio alive.
Because the market knows it's risky, so the insurance costs more.
Yep. So they use a put spread instead. You buy a put option to protect your downside, say, on NVIDIA, if it pushes above $150. But simultaneously, you sell another put option at a lower strike price, say, $130.
Okay, so you cap your protection, but you slash the premium you pay up front.
That is the exact mechanism. You are defining a very specific floor for your losses without bleeding all your capital to option premiums.
I see.
And it proves that even the most aggressive bulls are deeply aware of this digestion risk, and they are mathematically capping their downside.
Okay, so we have Tepper and Griffin buying the future, paying whatever it takes to own the AI infrastructure moat, but they're hedging it. And while they're looking forward, other super investors are kind of looking sideways, scooping up traditional assets that the AI hype has completely left behind.
Yeah, the rotation is real.
Let's talk about Seth Klarman. Klarman is a legendary value investor, and he clearly sees a structural shift in the banking sector right now. He aggressively bought financials this week.
He did.
I mean, his largest ads of the week were bumping his Wells Fargo position by a massive 25%. And adding 20% to Citigroup. Why banks? Why now?
What's fascinating here is the underlying macroeconomic mechanic driving Klarman's trade. It's known as the steepening yield curve.
The steepening yield curve. Okay, walk us through that.
So to understand why Klarman is loading up on banks, we have to look at the inflation data from August 13th, which came in milder than the market feared.
Right, and when inflation cools, the market immediately prices in the expectation that the Federal Reserve will cut short-term interest rates.
Yes. So the short end of the yield curve drops. But remember Ray Dalio buying long-term treasury bonds earlier in the week?
Yeah, the TLT trade.
Right. He was betting on long-term rates stabilizing or staying relatively elevated because of the massive U.S. fiscal debt issuance required to fund government deficits.
Ah, okay. So the short-term rates drop, but the long-term rates stay pinned high. That tilts the seesaw.
It creates a steep slope. Now, apply that slope to a commercial bank. Banks basically have one foundational business model, right? They borrow money at short-term rates. This is the interest they pay you on your savings account, or the overnight lending rate.
Right, which is suddenly getting cheaper for them because of the rate cuts.
Exactly. And then they lend that money out at long-term rates, like a 30-year mortgage or a corporate loan.
And since the long-term rates are staying high, they can still charge a lot for those loans.
Exactly. So the wider the gap between their short-term borrowing costs and their long-term lending rate, the larger their net interest margin.
So it is pure profit expansion for the bank without having to acquire a single new customer.
The steepening curve is absolute rocket fuel for bank earnings, and that is why Klarman is scaling so heavily into Wells Fargo and Citi right now. And once again, the algorithmic data aligns perfectly with the billionaire filings here.
Let me guess, the Danilfin scores are lighting up.
Oh yeah. Danilfin scores for JP Morgan, Bank of America, Goldman Sachs, Wells Fargo, and Citi are all flashing solid 7 out of 10s. It is a highly coordinated structural rotation into financials based purely on interest rate mechanics.
It is brilliant when you see the puzzle pieces fit together like that. Like Dalio's treasury bond trade and Klarman's bank trade, they're reacting to the exact same macroeconomic catalyst, which is the shifting yield curve. They're just utilizing completely different instruments to extract a value.
Yeah, they're basically exploiting the spread between monetary policy and fiscal reality.
Man, that's cool. So we have the AI future, we have the traditional banking sector, and we have the defensive energy bunkers. But I want to pivot to the most surprising anomaly in this entire brief, at least for me. It has the Grok undervalued screen pointing directly at Hong Kong.
Oh, yes, the deep value play.
Right. The data points out that Hong Kong equities are sitting at multi-year lows. We are talking about foundational tech monopolies in the region like Alibaba Health and Tencent. And the Danelfin AI is giving both of those an 8 out of 10 score.
Yeah, strong scores.
Plus, the KWEB ETF, which tracks Chinese internet companies, is showing technical signs of life. But the sentiment around China has been incredibly toxic for global investors for years now.
Yeah, totally toxic.
Due to regulatory crackdowns and the property sector collapses. So my question is this a classic value trap where a stock looks cheap but eventually just goes to zero? Or is this potentially the contrarian trade of the decade?
Well, the sources make it clear that it is the highest variance trade in the entire briefing, meaning it could swing wildly either way.
Wow.
Our sources identify dual catalysts that could unlock this value, but they also brutally quantify the risks involved.
Okay, so what's the first catalyst?
The first catalyst is China stimulus expectations. Basically, the global market is waiting for Beijing to inject serious fiscal liquidity to revive their stalling domestic economy.
But wait, the data explicitly slaps a 35% probability risk on China's stimulus failure. It notes that policy signals from Beijing remain incredibly mixed. A 35% chance of absolute failure is a massive hurdle for any investor.
It is a huge hurdle, which is why the second catalyst is actually the true engine of the trade. And that is AI adoption finally reaching Chinese tech at scale.
Okay. So how does that work?
The thesis is that if Tencent and Alibaba can replicate even a fraction of the AI-driven efficiency gains and the product growth that Meta and Google have achieved in the U.S., their current multi-year low valuations become incredibly asymmetric.
And just to clarify, asymmetric meaning the potential upside vastly outweighs the downside risk, assuming you size the position correctly, right?
Exactly, because if they fail and you sized it right, you lose a small position. It's manageable.
Right.
But if they succeed, the multiple expansion could be historic.
Ah, I see. You are buying monopolistic tech platforms at basically utility-like valuations, but with a free call option on artificial intelligence integration.
That's a perfect way to summarize it. It's high risk, but the payout structure is very appealing to contrarian investors.
And speaking of contrarian risk appetites, we just saw Klarman buying the ultimate Main Street proxy with banks, right? But if we look at consumer spending directly, the data shows everyone is terrified of a recession.
Oh yeah, consumer sentiment is shaky.
The consumer discretionary sector as a whole was bearish this week. It was down 1.1%. People are really worried about the average consumer just running out of cash. Yet, there's one massive anomaly in the brief.
Ackman.
Bill Ackman is out here buying hotels and burritos. Why? Why is he doing that?
Well, Ackman is running a very specific thesis here. It's called consumer discretionary resilience, but it's tailored exclusively for premium brands.
Premium brands.
Yeah, so he added 18% to Hilton Hotels,
Wow.
and he initiated a brand new position in Chipotle.
Wow.
But at the exact same time, he actively reduced his stake in Restaurant Brands International, which, for context, owns Burger King and Tim Hortons. He reduced that by 12%.
So he is completely bifurcating the consumer.
Yes. He is betting that the higher-end consumer, so the demographic that is staying at Hilton and paying premium prices for fast casual at Chipotle, he thinks they will remain economically resilient.
While the lower-income consumer, the one relying on traditional quick-serve models like Burger King, will just continue to pull back due to inflation exhaustion.
Precisely. It is a very surgical strike in a bearish sector. He's separating the premium spenders from the broader economic drag.
That is so smart. Okay, so we've covered a massive amount of ground here.
We really have.
We've mapped the geopolitical conflict zones with Buffett and Dalio. We've broken down the AI infrastructure moat with Tepper. We've explained the yield curve steepening that's fueling Klarman's banks. And we've looked at deep value in Hong Kong and Ackman's premium consumer play.
It's a lot of moving parts.
It is. So what does this all mean? Like, how does a listener actually apply this to their own portfolio framework without getting complete whiplash?
Well, to synthesize all of this, you have to start by structuring your risks. Before you allocate a single dollar, you have to know what specific events can completely destroy your thesis.
Right.
The sources outline a very specific risk radar that essentially dictates the portfolio sizing.
Let's run through that radar. What is the absolute biggest, most immediate threat out there right now?
The highest probability risk right now, which they quantify at 40%, is Q3 earnings revision risk.
Okay, meaning companies beat their Q2 numbers, which is great, everybody cheers, but now the market is terrified. They are going to lower their forward guidance for the rest of the year.
Exactly, because the market is purely forward-looking. It's all about the digestion of those Q2 beats.
Yeah.
If the forward guidance softens even slightly, the high valuations we are seeing in certain sectors, especially tech, they become incredibly fragile.
So a company can report record profits today, but if they tell investors things might slow down tomorrow, the stock just craters.
Yep, it craters. And then there is a much more acute, localized risk mentioned in the brief as well.
Right, the black swan.
Yes, it's a classic black swan localized event. It's a 15% probability risk surrounding accounting and regulatory reviews, specifically for SMCI, which is super microcomputer.
And SMCI has been a massive player in the AI hardware space. Like, they've had a wild run.
They have, but the data specifies that they have recently brought on a new auditor, BDO, and the review period is currently active.
And when a hyper-growth tech company suddenly changes auditors, the institutional market usually gets very nervous.
Very nervous. If an accounting irregularity is triggered and made public by BDO, our sources estimate it could cause a 30% instantaneous drop in the stock.
A 30% haircut just on an auditor's footnote. Ouch. And this is exactly why position sizing is basically the only free lunch in investing, right?
Absolutely.
Which actually transitions perfectly into the final, and I think arguably most valuable part of this briefing, the actionable model portfolio. Because the sources take all these super investor moves, Buffett's cash, Tepper's AI, Klarman's banks, and they distill them into exact sizing parameters for a balanced strategy.
And this framework is just a masterclass in modern barbell investing.
Let's define that. Barbell investing, meaning you have extreme, high-growth, aggressive assets on one end of the weight bar and ultra-safe, defensive, heavily anchored assets on the other end with very little sitting in the muddy middle.
Exactly. You balance